Welcome back. You're still tuned into Market Fatafat right here on ET Now, and time to get your big voice on the show then. In an exclusive conversation with ET Now, Alka Anbarasu from Moody's Ratings and Karthik Srinivasan from ICRA talk about why they think India's financial sector is holding up the impact of US tariffs even after 2 months of its imposition. ET Now's Anurag Joshi also asked them about India's position versus its Asian peers and where they think credit growth is headed from here on. Listen in to what they had to say.
We do think that India is more resilient than some other countries in the region, and we have called out some countries that are more vulnerable to the impact of US tariffs, whether it's China or even in ASEAN, some countries like Vietnam, Thailand, and closer to home, Bangladesh. But we think India is more resilient. Perhaps the first factor is that India's trade exposure to the US is much lower, and within the sectors where the tariffs are going to be imposed, we do think that India's domestically focused economy provides a bigger resilience to the domestic manufacturers against the US tariffs.
Now, Karthik, to you, the latest reading of the GDP in the Jan-March quarter, it is a faster than forecasted GDP growth for India. In terms of, then the corporate earnings are also showing signs of picking up. In terms of like the stability of the Indian financial sector, what's the fallout from the latest GDP reading? In the sector has been resilient, but would this add more weight, and would this make the sector, it'll strengthen the sector further?
See, the banking sector has a stable outlook. We're doing pretty well as compared to what we were a couple of years back. So the GDP strong imprint for Q4 and the expectation that the GDP for FY26 will be in that ballpark vicinity of about 6.3, 6.5 does definitely provide comfort and buoyancy for the financial sector. And also the latest tax swaps and the much better liquidity position in today's banking system, does provide opportunity and hope that the deterioration in asset quality that one has seen over the last couple of years could possibly come down. Notwithstanding that, one also needs to factor in that the banking sector is fairly robust at this point in time with strong capital and very good profitability as well. So they should be in a position to marginally, manage any blips if they were to happen during the course of the year.
Now the latest commentary on India's banking sector, Alka, and you are expecting the net NPLs for Indian banks to be about 2.5%, in the next 12 months, and that compares to 2 to 3% was your forecast for the last year. Are there, given the fact that you're still pretty optimistic about the level of bad loans in the system in India, are there any red flags? Are there any risks you could like to highlight, which could worsen and which could probably vitiate the situation?
So we're not very optimistic, but we're stable on asset quality of Indian banks. So we think asset quality will remain stable. And actually, if I break down the loan books of banks and the sectors, we think corporates, which accounts for nearly more than 50% of the banking sector loan book, should broadly remain stable. We don't see any stress within. There are maybe some idiosyncratic issues, but generally we do see broad stability in the corporate asset quality. Even within the retail, there are perhaps two segments. One is the secured, which would include the home loans or loans against properties. We think broad stability in those sectors as well. It's really the unsecured segments that are posing some asset quality issues within the unsecured segments, and banking sector doesn't have a lot of exposure to the unsecured segment. It's much more with the NBFCs. But within the banks as well, whether it's microfinance or unsecured retail loans, unsecured SME loans, those are the areas where we do see some pain yet to come through. But broadly we think despite those issues, we think those account for a small share of the banking sector loans, perhaps 15%, 20%, not a lot more. And we think those are quite manageable. And we think that over the next few quarters, perhaps the stress even that is built up in this sector will also come down, and therefore it will support stable asset quality for Indian banks.
A recent judgment from the Supreme Court, Karthik, where which is seen as a setback to the resolution process under IBC, where they have invalidated the resolution process for Bhushan Power and Steel that was going to be taken over by JSW Group. Now, do you expect more judicial interventions taking place in the IBC process, and will this affect the pace of resolution of insolvency cases in India?
Well, it's a tricky development which has happened now. I know we need to wait and see how the courts finally decide on this. But clearly the process, that does raise question on the entire process, if what really happens as far as the outcome on this transaction is concerned. Having said that, it would definitely raise questions on the entire IBC process. So we need to see how the courts take a call on this, and then subsequently, will judicial action be more or less? It'll probably be a function of how the outcome is. Very difficult to take a stand at this point in time.
Okay, right. Also in the commentary, Alka, you have mentioned that, the unsecured retail loans in India, they're still riskier than other forms of credit. RBI in the past, they've taken steps. They've clamped down on, lenders extending credit through unsecured loans. How difficult is the risk? How difficult is this problem now? And is unsecured, even though steps are taken, and you think that there are still risks which are lingering there in the system, which, the RBI needs to do more to curb? And is this a risk? Unsecured loans, are they a risk, which could balloon in the future?
So the unsecured loan risk is more in the bottom of the pyramid, where a large share of lending has taken place via not just banks but also NBFC segments like microfinance, where increasingly lenders were giving out loans and the leverage of the borrowers increased. Beyond microfinance, there are unsecured personal loans, but also a secured segment, which is gold, loan against gold jewelry, which also saw significant growth in the past year, about 30-35% year-on-year growth, on back of increase in gold prices as well. So effectively the leverage of the bottom of the pyramid has increased, and that is where the concerns come for the unsecured segment. And we have seen that new NPL formation rates for microfinance companies that are more focused on the unsecured segments have increased in the past year. Having said that, you rightly said the regulator has taken several actions, whether it's curbing the amount of microfinance loans, but again the regulator has come up with guidelines against loans against gold jewelries, and the growth in this segment has materially slowed in the past 2 quarters. So we do think that while there is some stress that is yet to be come out, but we think we may be reaching a peak. Perhaps an unknown factor is political risk, particularly within microfinance. There tends to be episodes of political interferences, and that could also cause some borrower behavior to distortion in borrower behavior. So that's another area we're watching out for. But broadly for banking sector, this risk we think is manageable. It's really the monoline, perhaps NBFCs where we may have some concern.
What's your view about capitalization of Indian banks currently? Most lenders have said that they are very well capitalized. CAR, the capital adequacy, is well above RBI limit. So going ahead in terms of raising new capital, are there any challenges for Indian banks?
Capitalization is one area where a lot of work has been done by Indian banks post-COVID. The capital ratios of public sector banks, perhaps barring SBI, CET1 ratios have reached 13%, and for large private sector banks, CET1s are generally above 15%. And when we compare to regional peers, the capitalization of Indian banks is fairly adequate at this stage. We do know that the public sector banks have frequently raised capital in the market also over the past year. And for the private sector banks, as I mentioned, the capital is quite strong. Many of the banks also have capital in subsidiaries that they could monetize by listing some of those subsidiaries as well. So from a capital perspective, we think banks have adequate capital to support credit growth over the next 2 to 3 years.
Right. Any forecast or any kind of an estimate Moody's has about the amount of capital Indian banks will require? Say, I mean, it can be like over the next 1 year or it can be over the next 5 years.
We've not published any particular estimates on capital needs, but we do think with the ROAs of banks reaching more than 1%, which means return on risk-weighted assets of more than 1.5%, and private sector banks are a lot more profitable, we think the capital, internal capital generation is adequate to fund even the credit growth that we are estimating in the system. We expect perhaps low teen level of credit growth, 11 to 13%. So we think from a capital perspective, they are generating internal capital and their capital ratios are already quite healthy. So actually we haven't published any estimate, but we think they can even fund this credit growth with their own capital.
Yeah. Sticking to capital, I mean, one sticky area is 81 bonds. And there have been precedents both in India and globally. If I look at 2020 when Yes Bank was restructured and fresh capital was infused by other lenders and which bailed out the bank, the 81 holders suffered. I mean, their investment was written off. More recently, 2023, Credit Suisse, their 81 bonds were written off. Both the times, the investors burned their fingers. And 81 is a key element of any capital structure of a lender. Going ahead, will raising 81 bonds be a challenge for Indian lenders?
So 81 capital by design are meant to absorb losses when a bank runs into trouble, and that's what we saw in the Yes Bank case or in the Credit Suisse case, where they are meant to absorb losses and limit taxpayers' money to bail out a bank. So in effect, the functioning of the 81s has taken place as they were meant to be. Considering the core capital of Indian banks has improved, their profitability is in a very healthy space right now, we don't see constraints in banks being able to raise 81. Obviously, investors would be wary about the risk of these instruments, but that would get reflected in the pricing to some extent. But globally, we do see banks issuing 81s even after the Credit Suisse event. We continue to see 81 issuances globally. Even Indian banks have raised 81s post Yes Bank situation as well. But broadly, it's more about perhaps investors identifying the risk of these instruments, which may get reflected via the pricing as well.
Karthik, what's your outlook on profitability of banks?
See, the banking sector today at the aggregate public sector plus private is having an ROA in that vicinity of about 1.1, 1.2%. Our outlook for FY26 is there could be a marginal compression, but we should still be in a position to maintain an ROA in excess of 1%. The reason for compression that we're looking at is some compression in interest margins, because it's going to be difficult for banks to cut their deposit rates, though some of the large banks have already taken steps to cut their rates in April and May. But it's going to be a bit of a challenge. So we do see compression in margins as RBI is likely to cut repo rates further. Almost half of the banking sector books is linked to external benchmark rates, which will get repriced at a much, much faster pace. So a pressure on that side would be there. Plus, last couple of years, the banks also benefited from strong recoveries from earlier problem assets. A lot of recoveries and write-offs have already happened. So from that level, the credit cost is also likely to inch up slightly. On the positive side, with the fall in interest rates, banks do have a significant opportunity to book treasury profits during the course of the year. So net, while we do expect profitability to marginally come down, but it'll still be fairly robust at a sectoral level.